Hello there, Oak Bloke here, and this video is just really to chat through the things that have been going on this week, some of the things that I've got in my mind, also to do an update on the Oak Bloke 25 for 25. So really smashing results. As you can see here, it's where are we up to? 24.8% return year to date. So really pleased with that. I'm a silver medalist, not a gold medalist, because in the Oak Bloke Fun Run, I'm not quite in the lead, but and the Fun Run you can see here is this was the last official article that covered it, and back just what was it, a month ago now, 21st of June, so 4 weeks ago. I was at 18.6, so 24.8. Happy with that. That's 6% in a month. If I keep going at that speed, it'd be that'd be 72% by the end of the year, and that's without any compounding. So if only it was always that easy, which of course it isn't. But just wanted to talk about what I'm seeing is working well, what's not working well. You know that if we so this of course the gold medalist, Mr. John, that was his result back in but this was mine. So if we compare this with today, so we can see like, for example, Macango back then was up 49%. Well, guess what? Today it's up a stunning 228%. So it's a triple bagger, and I've got two double baggers, Thor and Maffel as well, and Kavango is quickly getting close to being my fourth double bag, or my third double bagger, I guess you could say. But also, I just call out Energy Fuels up 45%, and just a month ago it was down 15. And I was sort of saying, you know, that as far as I was concerned, that it was a matter of time until the whole Trump tariff thing around uraniums, around rare earths, around the support from the US government was going to kick in. And guess what? It's kicked in, and that's true of Macango as well. So number one and number five are very much around the theme of uh, and the theme of sort of Trump and tariffs. When I was designing this 25 for 25 idea, that wasn't a thing, because last December, that I mean, it was he'd just got into or just been elected. Biden had been sort of runner up in the presidential race, so Trump wasn't even president. I mean, of course, vaguely, it was sort of vaguely on my radar that he was planning tariffs. But the thesis with this was that it was unique technology, IP. Not only did it have a very exciting mine and a refining center, and the underlying theme of the you know, at some point the whole thing with the Chinese having control of rare earths was going to come to a head. So both of these two ideas was very much a play on that theme of, like, at some point that has got to kick off. So obviously it's kicked off a lot quicker than I anticipated. Number 2, 3, and 4 are basically gold, predominantly gold. And as far as I'm concerned, I mean, whilst this is now at 40p, and I personally, I mean, I was buying Thor at a lower price than you know, this price that I included the article. So I mean, I think I've got almost triple the low point of Thor, but and actually the same with MAFL, that was just trading on silly. You know, the value at both of those was just incredible. Kavango obviously had a very checkered past, or just had some bad luck. I mean, you know, I think with the wonderful benefit of hindsight, digging holes 700, 800 meters down in the Kalahari Desert, doing something that nobody else had done. Maybe that was kind of quite a risky thing that they did with hindsight, but you know, they licked their wounds. They moved to Zimbabwe. I mean, they've still got a claim in Botswana, and that alone could be worth a great deal someday. But yeah, certainly the stuff that I'm seeing going on in Zimbabwe is just incredible. And when you consider that, you know, there's what 40 billion 40 billion worth of market caps producing in Zimbabwe. So that's Western miners and producers that are based or partly based in Zimbabwe. When people say, oh, well, because it's Zimbabwe, it's doomed to fail. Well, I just don't buy that. I don't accept that. And that's proven to just sort of not be the case. And this whole thing of the 26% free carry, I mean, again, certainly hasn't happened yet. Could it happen? Might it happen? Yeah, it might. But, you know, you can have that in the UK. The UK government introduced a 78% tax, far higher than pretty much, you know, any other country in the world tax on their oil and gas. So you know, the fact it's Zimbabwe isn't a sort of to my mind, an absolute reason just to kind of kick it into touch. And so it's proved. So we'll see. Number 7, or number 6 rather, Theresa. So this is PGMs. And again, I wrote about this last year where I was saying, like, I'm looking at the supply and demand and something's not adding up here, because, you know, how can it be that platinum the platinum market is in deficit, yet the prices are dropping? It didn't make any sense to me that, and this was true of platinum, palladium, and you know, all of the PGMs. They were all in deficit. What seemed to be happening was that there was investment flows where ETFs were giving up their platinum, and so there was supply onto the market through that. And then I read a story about how the Chinese had done some stuff around scrimping or economizing on the use of PGMs in their vehicles, and therefore that that again, they dumped excess stock onto the market. So you had this scenario where you had this sort of temporary blip of stock, but it was a matter of time until the PGM market went into deficit. And at the end of the day, I mean, platinum, when I wrote the articles about Theresa, I was like, well, you can buy 3 ounces of platinum to 1 ounce of gold. Like, if you own 1 ounce of gold, you could sell that. You could buy 3 ounces of platinum, and you're buying 3 ounces, 3 times as much of something that's far rarer than gold. Like, it just didn't make any sense to me. And also, the other thing I thought was, well, like, not being funny, but like, I don't know, maybe some people are a bit more sophisticated than me, but I can't tell the difference between a white gold and a platinum ring. So, like, the other thing that I kind of felt was going to probably be the case was that jewelry demand for PGMs was going to go up, because, like, not being funny, but you know, like, you can have a big thick ring that's made of platinum, or you can have a little slender one made of gold. Which would you like? Well, like, you'd get the one that's 3 times thicker, surely. Like, you'd be nuts to go for the little slender gold ring when you can have one that's chunky and looks expensive. I mean, maybe I'm just being oversimplistic here, but and so it has proved, because I read, you know, especially in places like India. Now, the Indians love their gold culturally. That's, you know, that's just I think a fact, or maybe just my opinion. I don't know, but yeah, I think you know, it's fair to say that it's very much part of gift giving and sort of, you know, like weddings and you know, giving of gold and jewelry. So anyway, I read that PGM demand in India had shot up, so that has proved to be good. I read Watkins Jones half-year results this week. Bad. I mean, I sort of skim read them when they came out, but sort of, you know, you get busy, something happened, the phone rings. So I properly read them this week. I was really excited. I couldn't believe that Watkins Jones had dropped down as far as they had. So if we just drag this across, I mean, let's quickly look at WJG. See if we can get WJG up on screen. You know, it absolutely had just fallen back. So, you know, like I was sort of thinking of it being at 40p. And look, it's dropped back 40% to 20, 25, 24p. So I picked some more up this week. I said, well, look, that's just mental. You know, the results themselves, very strong cash flow, very, you know, no great profit, no great sort of profit outcome, but they're well above water, and you know, the turning of the tide is happening. And again, you know, like you look at the number of students, number of admissions, number of, you know, the government are keen to try and sort of generate export income. Well, education and foreign students is a massive area. And you think like now this year with Trump um, kind of putting the finger up at you know, immigrant visas for students. Well, there's a massive opportunity for Britain. Massive. I mean, like if you've got half a brain cell, you'd be saying, right, let's kind of really market ourselves, because you know, if they can't go to the US, because the US are just basically sort of saying no visas, well, next destination probably on the bucket list is London and Oxford, Cambridge, and other universities as well. So, you know, there's a real opportunity for student accommodation. And not being funny, but students coming from abroad, you know, they're not going to go sort of looking for like a rental on Rightmove or something. It ain't going to happen. They're going to go for student accommodation. So PBSA, you know, as far as I'm concerned, the demand for that is pretty solid. So for it to be right the way down here, I mean, I have taken full advantage of of that, of what I see as an opportunity. So the fact that you know, it still has contributed 0.9%. And you can see here it's up 31% since I included it in the Oak Bloke 25/25. But even so, even at sort of 31% up, like 25p is just silly, because that values the whole thing at 63 million. Anyway, I'll be writing an article, just kind of working through the numbers with some detail. Serica, so Serica has got its Triton back online. So I think probably one of my favorite article pictures is the one for Triton. It's if I ever feel down, I just open that article because it does just make me chuckle. Uh, so it was this article from April called "Squeeze It Through Your Triton," which is just as I say, it just immediately cheers me up. But yeah, I mean, the result has cheered me up as well. So it's up 26%, but this is this one and this one. So Serica and private equity ETF. I loaded 6 times. So you know, I had an imaginary 35,000 portfolio, so 25 ideas, but 2 of them were 6,000 instead of 1,000. So when this one's up 26%, that's kind of like a double bagger essentially, because that sort of 6 times that is 152%. So I'm happy, very happy with that. And obviously this one is only up 1%, which is overall 0.1. So that's sort of not really doing very much for the portfolio. But again, you know, go back a month, that was on a loss. If we go back to XLPE, there he is there. You know, it was down 10% a month ago. So it's you know, again, that improvement has given me like a 60%. It's equivalent of a 60% improvement, because it's a six times weighted element. So Livermore, I did buy more Livermore as well. Not this week, but a couple of weeks ago. That's kind of what it was. Not, I think it was just after I wrote the article on Livermore, which was the one relating to peachy existence. So in this article, peachy existence, this article was very much looking at not just the fetcher. So I'd looked at fetcher before, liked fetcher, and it was very strange for me that the reason that Livermore had dropped in value was because they'd written down fetcher. When you look at how much it's kind of, how loyal their customers are, should we say, it didn't make much sense to me that there was a 2.5 times up round. So the valuation was 2.5 times higher in May. So they valued it at $250 million, which would make the Livermore holding worth 28.77 million. But then on the 31st December, they dropped it down and reduced it again. So not sure why. They don't say why. You kind of so they've got it valued at 11 million. Or 11 million pounds. So that I've just realised that should be pounds, not dollars there. But they've dropped the valuation by 10.33 million. But we'll see. I think there's every reason to think that Fetcher can fetch a higher valuation in 2025. But the other one I looked at was Phytech, and I really liked Phytech. I really liked, there's the sort of it's all to do with fruit trees and having equipment that will make the crop growing as efficient as it can be. So this is a dendrometer, I think they call it. Yep, it's this thing up here, dendrometer. That's a tree trunk that you see in there. It will measure the tree trunk. So when the tree is thirsty, there's microscopic little changes that this dendrometer can pick up and go, hey, the dendrometer is saying the tree's thirsty. Let's give it a little bit of water. And then up goes the water. So they don't overfeed the trees. They just water them just enough. So I mean, one of the innovations was this whole idea of what do they call it? Drip feeding agriculture. There is a specific term, but anyway, the step beyond that is to say, well, let's drip feed them when they actually need the water. So let's not overwater them. So very clever technology, and it's not just feeding them water. It's also so this thing about frost management. So again, if you ventilate the trees, and it just blew my mind that they do this stuff. But if you ventilate, you'll get rid of the cold air and stop frost forming on the trees. And if you stop frost forming, then you don't end up with ruined fruit. So yeah, very clever stuff. And they've done some partnerships with Rivulus and with another sort of equipment, or I think it was Orbia, that that basically takes the software of Phytech, which is a Livermore holding, and the equipment that these other two companies produce to basically just provide an integrated solution across the world. So, and these so Netafim and I think it was Netafim and Orbia. I mean, they're both massive, like absolutely massive. Like this one's got 7,000 growers, 6,000 partners, 3,000 employees. So there's this partnership, and then the second one, they're an 8 billion annual turnover precision agriculture business, but they do all of the clever equipment like the dendrometers. But the bit that Phytech bring to the party is this whole software and management piece that sits around it. So it's this sort of Internet of Things where somebody provides the things and you provide the internet and the sort of brains, and then stick it all together, and you've got sort of this monitoring, alerts and notifications, and irrigation valves, this whole sort of automation of rather than sort of walking around with a watering can, that you've basically just got computers feeding the trees, feeding the orchards, and checking the soil, checking the trees themselves to work out whether they're thirsty, because trees don't scream. If they're thirsty, they just sit there, as you probably know. Anyway, that's probably enough about Liverpool. Um, Gore Street, again, they released their results this week. The results were positive. They dropped in price. I was very tempted to buy more, but I had committed to other things, so I didn't. I have got quite a nice holding in Gore as it is, to be fair. So Pershing, not much news on that one. I mean, it's doing okay. Oceans dropped. Now this was interesting. They basically they've done a tender offer, plus they did a 60p dividend. So this dropped by about 60p this week. I was quite tempted to buy more, just to kind of take advantage of that drop, but Mercia's also announced some good results, really strong results actually. And they're up, but they're only up by a little bit, so there's still a lot of value as far as I'm concerned, up 12%. JPL up. I think their last results were back in March. There's not been a lot of news. SEIT were down quite a bit a month ago. They're up. SEIT were down. Where were they? Here they were down. Oh, sorry, they were up, but they were up 1.3%, so they're now up 10%. So, this is one where there's a nice chunky dividend. That's and I kind of felt that there was going to be a strong result. It sort of pointed to it, and since the results, since they released their results to March, they've also sort of been able to refinance the car charging Zood part of the Zood holding. So that's all heading in the right direction. The Japanese smaller. So I unfortunately the service I use don't allow me to put trusts in there. So I sort of put Shin Nippon in there so I don't forget about it. But that's the smaller Japanese. That's actually sort of doing quite well. That's up as well. Ovation, I wrote about recently. I mean, for it to only be up 2%, when air travel is as busy as it is, every time I visit an airport, the airports are packed, absolutely packed, and they were packed before the holiday season. Obviously, we're into holiday season now. Planes are very, very busy, and the plane manufacturers just there's a big shortage. There's going to be a shortage for years. So I think Ovation, I mean, it's almost like what could possibly go wrong when they're paying down their expensive debt. They're going to be refinancing. They can't refinance the debt until October without paying or if they refinanced it ahead of October, they'd pay a massive penalty. So they're going to refinance it on or after October this year. They've got until October the following year. So they've got a 12-month window when they can refinance without massive cost. I mean, when they refinance, I reckon it'll probably go from about 8.5 down to less than, well, maybe 4.5, 4, maybe even less. That I think they're going to lock in some exceptionally good rates. And these planes are all on long-term contracts. As they renew the contracts, they're getting much higher lease rates. The planes that they've sold, it's been quite a bit of smoke and mirrors as to sort of what the financials look like. They don't sort of they're not forthcoming. When in the RNS they just say, "Oh, the cash proceeds are this much," and then you've got to sort of make a best guesstimate. But on the 777 that they sold, I kind of thought 110 million. So that was based on the fact it was an 8-year-old plane, brand new. They're 350 to 375. So I sort of worked through, the depreciation would be this much. It's still got 5 years contracted at this rate per year. So I worked through the numbers and it felt like 110 was about right. So that's a massive chunk off the debt, So there's lots going on with Ovation. I think um, XLPE. So, I mean, we're just getting into second quarter earnings season. ICG is one of the holdings. I think it's the seventh largest. They reported some really strong results this week. Pretty much all of the other, whilst the UK and the US are sort of, the economies do have issues. I think the private equity are just marching on, marching on. So I don't have too many concerns about that one. And again, I'll be writing about that at some point. My last article was Gordon Gecko or something along those lines. So it looked at let me see if I can find it. It was where's it gone? Yeah, lunches for wimps. So in that, I was sort of looking at some of the just looking at some of the holdings, and so at the time this was sort of down 10%, and I was just looking at sort of like let's look at the ones that have. So these are the sort of main holdings. So like this one up 21, this one down 21, this one down 10. So I sort of got into the sort of weeds of, well, why is this one down 21? So KKR as the example. So here, seemingly strong result in Q1. So you can sort of see it here for yourself, adjusted net income up 37%, fee related earnings up 37%, capital up 16%, management fees up 15%. So everything's heading in the right direction. So to be 21.4% down is quite harsh, and obviously that's feeding into the ETF value. The sort of thing that was, and you can see here, it was a beat on what they forecast as their earnings. So again, that all looked good. Now it turns out that there was this net income loss attributable. So you can sort of see it here for yourself that this loss was, can you see, sort of 861 went to non-controlling interest, so that it was that. So actually they made 684 million, but then 861 was the offset to non-controlling interests, and that was now a lot of this was just down to the fact that these guys are using GAAP accounting, not IFRS. And what that means in plain English is that when you have exceptional costs, the exceptional costs have to just be factored in as sort of like there's no exceptions. In GAAP accounting, you just have to report it as it is. If you actually sort of say, well, let's just sort of strip out the exceptions, then I mean, basically, you get to a very, very, very different result. And you can see here, the growth that they're achieving, the fees that they're achieving, it's all heading in the right direction. So like I was pretty relaxed about XLPE on that basis. I thought, well, and then the next two, NubDug, I called time on when it was plus 40%. It dropped. It's kind of gone back down again. So I actually wrote an article where I said I'm going to reincarnate NubDug, but basically, rather than sort of confusing the scores, I've sort of said I'm doing it, but I'm not going to count any gains. Like it's not back in the competition. It's just I'm just saying like at so I picked it up at 31.5p. So I think at the time it was on a 29 to 33 spread, maybe, or no, it wasn't. It was a 28 to 32 spread, 28p to 32, and I was able to buy it at 31.5. Obviously, it has moved slightly this week, so I bought it back down here. But essentially, sort of at that that line level there. But when I looked at the the two assets, they've got two assets left, they've got a load of cash, um, and like, well, even if you sell one of the two assets, then that's sort of the NAV, or sorry, that's the share price back. And if you sell both assets, then there's profit. So yeah, to me, it's like a short-term way of just being able to get a very quick return, or hopefully a quick return. I mean, it's not guaranteed, but what they did say in their article was 6 months ago that they reckoned it would take 6 months, and here we are 6 months later. So we'll see. I mean, it might be that it drags on, but even if like I tie my cash up for 6 months and I get, well, even just like a 10% return or a 5% return, 5% in 6 months is a 10% return. So, I'm happy with that. I'm happy to take like just take a slice of something that's low risk as far as I can see. That yeah, that nothing's guaranteed with this, and it's not advice, but you know they've valued the asset professionally, and it's yeah, there's a margin of safety when it's on a discount. I think it's the two remaining assets come to about 48p. So if I'm paying 31p for 48p of assets, well, unless they sort of go for half price, which would be a pretty terrible result. And even if they went for half price, well, I'll lose like 10%, 20, 15% of my money. But that's quite an extreme outcome. If the outcome's a little less extreme than that, I'll make 5%, maybe make 40%, and if it surprises to the upside, then maybe make even more than 40%. If I can make 40% and the news drops in August, well, like that's break open the champagne, isn't it? I mean, I don't want to sound glib or whatever about it, but on a balance of probabilities, it feels like a good sort of reasonably low risk water intelligence. I still don't like. Obviously, it was one of my ideas, and then I saw the Q4 results. I didn't like them. I saw the Q1 results. Really didn't like them. Yeah, and I've since seen the full year results. I just don't think this is the great. Um, they were heading in a good direction, but there was a few things that red flagged it for me. With hindsight and with retrospect, the product sales just weren't going the way that they were supposed to. Considering that they said about these exciting products they had, well, why are they not selling more of them? And can it selling services sort of make it prosperous? Maybe, but the whole the whole sort of rationale to my mind was that you can sort of sell these recurring products and recurring sales. And I think the thing that did it for me was when I looked at Ondo InsurTech, and I think, oh, I haven't put it on my list. I do want to talk about Ondo InsurTech just quickly. I didn't intend to, but Ondo, I've kind of just with a few different people been chatting, and I sort of have for a while, like it dropped down to here, and I've bought more and more and more of it because I was like it seems to me that this genuinely has a solution to dripping water leaks, that the water intelligence one needs a plumber to install it. You need to cut pipes, and like, not being funny, but as soon as you talk about cutting pipes, like, you'd have to be mental to be not a plumber and to go cutting pipes. I mean, you'd be asking for trouble, as far as I'm concerned. That's just my opinion, but it just seems to me that like you could only do that through a plumber. And then the price of the product from Water Intelligence was pretty high. um, and then it was totally unclear what, if any, skin in the game that Water Intelligence would get. It might just be that they get the revenue of installing this gadget, which that then, Chubb, the company that sell the product, they then get the subscription revenue. I mean, it was just not clear to me. And I think if a company can't be clear about these things, well, I'm not going to take the risk that they possibly are earning something. But at the end of the day, what they're doing is that the leak detection is based on the flow of water. Now, I really like the Ondo InsurTech because it works from the temperature of the pipe. And the point is that water coming from the ground, like when water comes into your house, it comes in from underground pipes. Um, just stating the obvious. Um, but but you can tell that the water is still flowing because the temperature of the pipe doesn't return to room temperature. Um, so sort of doing something based upon flow to me just seems like a less reliable measurement. And when I read that they could do it based upon 1 teaspoon in a minute, I mean that to me is like a solution that works and works really well. And then when I sort of worked through the numbers in the article, when I looked at the model for the US, and it's $5 a month per customer, that basically they're getting that. So basically, the insurers, the US insurers, are charging that on. When I work through the numbers, I mean, it seemed to me that the economics of this were absolutely superb, absolutely superb. The bit that sort of obviously people are worried about is, can it turn profitable? Can it sort of get to a point of profitability? Well, when I was looking at it, I was like, well, it seems to me that they'd have to make some really serious blunders to not turn profitable and to not turn cash flow positive, because like when you look at the number of subscriptions that they're declaring, like, and if they're all paying $5 per month, and this is just the US ones, by the way, well, I mean, it it sort of very quickly turns cash flow positive. So you can sort of see I've put into here the like when I looked at the amount of deferred revenue, when I looked at the fact that they were basically funding the working capital by the insurers prepaying for water for leak bots. So lots and lots of reasons that I kind of looked at it and thought, well, this is a massive, massive, massive opportunity as far as I can see. And it's just today that it's gone shooting up. So I don't know the reason for it shooting up today particularly. But I'm not surprised because for it to have dropped down, I mean, and I did have some debates with a few people where they said, oh well, it's the fair value is this and the fair value is that, and I was like, well, but you do realize, like, once this thing starts sort of really starts printing money, that it's like you're going to have to start valuing it very, very differently to how it's being valued on a sort of like, can it break even basis, because I mean, the growth, like when you look at like this, for example, when you compare the actual households that are sort of activated versus the number of addressable households. I mean, like taking say this point here, like this point here to this point here is a static increase, whereas this point here to this point here, I mean, this is exponential. So this has gone 7x between October 23 and today, or when I think the last measurements we had was sort of March 25. So in those 18 months, that has 7x'd, but that number there, which is what, 80,000. So it's gone from 80,000 to 140,000. So that's not even 1x'd, or 2x'd. That's not even doubled. The blue line's not even doubled, but the addressable market has 7x'd. I mean, when you get your head round like the fact that the amount of penetration, and also the other thing that struck me was the degree to which the American insurers are really embracing this. And again, this is just stuff on Twitter, stuff in interviews, and it's just me piecing things together, but looking at the way that the Americans appear to be sort of rolling this out far faster than the Danes and I think it's the Swedes, the Danes and the Brits rolled it out. The European insurers rolled it out. The Americans are far more proactive, probably because American houses and the claims for water damage are pretty significant. So anyway, for whatever reason, I think the American growth is going to be really rapid. So we'll see. We'll see. I think. Sorry, I didn't have that on my agenda, but anyway, um, sort of APAX is also up quite a lot. It dropped down to I think £1.11, £1.10. It's now at £1.38 this evening. So it's gone up quite a bit. I mean, I did a couple of deep dives into the holdings. To be fair, I couldn't explain Safety Clean. There was a reader who said, "Oh, I worked in private equity and in services, and there's a couple of bad apples." Definitely, I couldn't explain Safety Clean and its valuation. It might be a bad apple, um, but equally, when I looked at all the others, I think Toy was another one. There was a tree surgeon one as well that they actually looked pretty good. The tree surgeon one, you could sort of imagine there being quite a sort of a logic to that it's this going down the toy let so yeah, whilst Safety Clean, which does sort of cleaning of tools like the one that is being held in there, and obviously it's a separate company that does the toilets, but I sort of did a bit of a image merge with the two holdings. But yeah, I kind of totally took on board the thing about Safety Clean, but when I started looking at that actually looked like it could be a bit stronger. And Tree was the other one. So bit ironic that Tree chop down trees, but that's kind of yeah, that's their sort of, well, they do tree surgery, tree maintenance, that kind of thing, landscaping. So yeah, you could sort of imagine, people that just love climbing trees, chopping things down. Like, they don't want to be sort of sending out invoices and doing all of that malarkey. They probably would quite like to sell off their business and for it to become part of a national chain, and then they just work for that chain and they maybe get some sort of little bonus and whatever if their business hits X, Y, and Z profit level. But it's kind of a bit of a win-win as far as I can see. So yeah, that was one I really liked, actually. And I sort of go back to what I say, when you actually just go through, like, for the last, what was it, 4 years of results, look at sort of how these things have progressed. And yes, there were a couple of times that there was sort of negatives, but like when you look at these, for example, the IRRs, the internal rate of return, or the like the NAV value versus what it sort of got sold off at. So the unaffected valuation means, like, they had it, I don't know, let's say they valued the business at 5 million and sold it for 6 million. That would be basically an unaffected valuation of 20%. So it's like a 20% on top of what the NAV was. Now, bearing in mind that the NAV, the discount to NAV, even with it going up in price, it's still something like a 35% discount to NAV at APAX. So it's like, it makes no sense to me that something should be selling off, frequently selling things off at a premium, yet to have sort of like this massive NAV, 31% according to this. I think that's about right, actually. And then also sort of, yields an 8% yield. And if you picked up this share back when it was £1.10, I mean, you were getting a 10% yield. I couldn't believe it. I was like, wow, 10%. And then, like, the 10% is fully covered as far as like when you look at the gains, like, it more or less covers that 10%. Doesn't massively cover more than the 10%. So, like, I would have concerns about whether the level of yield is kind of maybe a little bit too high. But And you can see as well, like, you know, the realized gains, realized losses, and you know, and so on, that there was some good good stuff in all of this. So anyway, EMV's not sort of performed terribly well. We're onto the bad ones now, the bad apples. I still sort of think that this one could do well. It's got some really great holdings. It's just there, yeah, you know, they sort of are going to grow at the rate that they do. I think the sort of ecology aspect to some of them, the ventive, uh, basically is sort of heat recovery for houses and for buildings. That could do well. The little insulation robot insulation sprayer could do well. The plastic the plastic reclamation or converting plastics back into chemicals could do well. So there's some interesting holdings in there. It's just they haven't managed to kind of turn any of those into a like a closed deal or a realization, and that's the bit that holds back EMV, unfortunately. But having said that, I mean, all it takes is one deal and then it all changes. So it's on a massive discount. It's just whether you've got the patience. You know, should I have chosen something a little bit faster for a 12-month race? Maybe. You know, like if this were a 10-year race, I'd feel a lot happier about EMV than I do now, given that it's got 5 months left to sort of blow out the lights. But you just don't know. I mean, it, as I say, one RNS, one realization event, one you know, one piece of news could change it all. Uh, Robotics, you know, this year, like last year, didn't hear a thing about robotics. I think vaguely heard about Tesla planning something called Optimus. This year, I just keep hearing about robotics everywhere around me. It's yeah, robotics, robotics. I think this is an idea for 2025, and I sort of I kind of felt like it should be the time because, like, what's the point of AI if AI is just a chat GPT window piece of software? Like, at some point, AI to be actually useful for human beings has to have arms and legs or wheels or stuff. You know, that's the bit that's sort of missing now, that there's only so much you can do with software, that you need hardware to go with software, and that's what robotics is it's all about that. And I think the other thing that has become clear and obvious, and it was sort of percolating there in my thinking as well, was just around the whole Ukraine war, that like all you see is about drones and, you know, countermeasures against drones and missiles, and you know, it's sort of like robotics as a form of warfare. I mean, obviously military spending again has been very much thematic for 2025. I think, you know, when I looked at the number of holdings in that ETF that are military, have some element of military related, I think, yeah, you know, I'm not bothered about it being down 6%. It's not going to stay down 6%. It's been going up pretty steadily the last couple of weeks. It dropped because Nvidia dropped, and Nvidia's now at what, $170, and there's talk of it going to 200. And you just look at like the results. I mean, we'll see the Q2 results starting to come through. Look, if the results carry on as strong as they have been, I mean, uh, I think robotics will do very well in the second half. Pure tech, again, this is sort of one that's been a frustration, that if this were a 10-year race, I'd be a lot happier than it's a 12-month race. But like, I made my decision to don't regret including it, because like even this week it released news about Seaport, one of its holdings, and um, you know, it's an ongoing set of trials. I think it's just that it might not be 2025 that it sort of goes into the stratosphere. But then equally, I could have said that about Macango, might not have been 2025, and here we are, and it's up 228%. So, and finally, Cadence. Cadence has dropped, but that's been slowly going up this week. Now, it's interesting because I think the thing that's driving that is that iron ore itself has been recovering this week. So if we look at cadence, it's at 1.8p. Earlier this week, it was at 1.5. So 1.8. So if we just go back, there we go. Yeah, 1.5, 1.8. So it's up 20% in the week. So I think it's fair to say if we just grab iron ore, let's go over here, let's grab iron ore. Iron ore has kind of had a bit of a turnaround, says he, 12% this month, up 12% this month. Now, yeah, so China's economy expanded 5.2% year on year in the second quarter, slightly above forecast, but down from 5.4 in the previous two quarters. Yeah, so I think that's what's driving, because Cadence itself, I mean, released news and they said, well, look, what we're going to do is we're going to do a restart of the mine. And you know, we're going to sort of do a sort of more limited, you know, this production plan and equity subscription. So the idea is that they're going to do a sort of more limited. So they've raised 400. They're recommissioning. They're sort of targeting a smaller restart of the mine. And you know, the capex. So the original capex was somewhere in the region of, forgive me, I haven't got the exact number in front of me, but something like $280 million. So they're now saying pre-production capex 3.5. You know, yeah, you know, production is expected to commence within 3 months. Well, that's pretty good news actually for something that you can buy, something that you can buy for 6 million quid. Yeah, that I mean, okay, yes, it's been battered and yes, it's down. I mean, if you sort of said take the 5 year, like, oh, you know, like, so I sort of said I included it here. So obviously it's down 20%, so year to date. But I think the fact that they you know, the fact that they've got this mine that can generate an internal rate of return that is superb, and because it's premium iron ore, it's 67.5% iron ore. This is a very, very high grade iron ore. If you're using electric arc furnaces, things like that, you can't put 60% iron ore in it. It's got to be high grade 67 or 66 plus. So yeah, I'm pretty positive about the Oakbook 25 for 25. I guess I am talking my own book, of course I am, but equally, this has worked as, you know, the only ones that you know, that of course there are some where I sort of look at like Ovation, for example. I think it's mental that that is only up 2% year to date. But yeah, you know, I could sort of probably give a bull case for every one of these. But yeah, I think I'm pretty pleased. I mean, obviously, I made a mistake with Water Intelligence. The idea was there, but the execution was not. With NubDug, did I sell out too early? No, actually, I think I did pretty well. 40%, 41%, whatever it was. I think that, you know, it did what I wanted it to do. It was a low risk. Let's just sort of take advantage of the silly discount level that is going to, you know, silly discount that's going to turn into cash. Actually, just quickly, the other thing I'll quickly talk about is Ocean again, because I mean, I couldn't believe that they're doing a buyback. So Salomon and the guys that own 60% of OCN are not participating. So they're basically doing a tender of 20% of the, you know, 20% of shares, but it's effectively 50% of the remaining 40%. They're not participating themselves. The NAV itself is going to increase by doing this tender of 20%. But essentially, it was guaranteed upside. And I couldn't believe that even, I mean, it's finally closed now. I think today was the last day, if I'm not mistaken. But I couldn't believe that there was this guaranteed upside that was just there left on the table, and like even if you bought it, tendered 100% of it, and then sort of with the proceeds, if you wanted to, still own OCN, which I mean, at the moment you can buy it at £14.10. I mean, on the basis that the NAV is about it's about 19, I think about £19.50, and with the 20% buyback, I mean, the NAV will be at about what 21.50, 22. I mean, and quite a bit of the fund is listed equities anyway, and it's sort of like, I mean, they've managed to eke out this generous dividend for a fair long while. I just think it's crazy that there was this ability to so the way that this worked was that you could sort of say, I'm willing to tender at different prices. So there was a sort of a I think it was a 1575, oh, sorry, 1543 was the lowest, 1736 was the highest. Because 50%, like like even if everybody tenders, you'll still get half of your shares tendered. And like I don't think anybody is going to be daft enough. Well, maybe a few will, but most people won't be daft enough to go for the low price. When I've seen these kinds of tender offers, and I've seen 3 or 4 in my days, 4 actually. It's always been that most people vote for the top price, because why would you vote for the lower price? Yeah. And because there was an option where you could say, um, you know, like give me whatever the strike price was. Okay. So in other words, um if like a vast number of people don't vote for that price, or the one above, or the one above, or the one above, if they did vote for that one, I think it was like 3% upside. But if if the final strike price is this one, I mean, it's like 18% upside. And because this is based upon cash that they've physically got, like literally, like there's cash waiting. There's no, like, apart from the vote not getting voted ahead, which, well, because 60% of the owners are voting for it, like, well, that's not a vote. Like, I couldn't see that there was a downside. I really could not. And it was like, even if, like, the only thing I suppose would be to say, what if you didn't get all of your shares tendered and then the share price crashed? I mean, I suppose you could lose, theoretically you could lose money, but when the NAV is going up as a result of this tender, why would the share price crash? That wouldn't make sense. When the NAV is the resulting NAV is being boosted by about 15%, that the share price should fall. When most people that want to head for the exit have had their exit through the tender, like why would then other people sell? Like, none of it made any sense why there should be that disconnect. So yeah, I just, it's a funny one. But hopefully we'll get the results quite soon, because I think they are going to announce it on the 21st, which is Monday. Well, I'll be looking forward to that, and then the proceeds by Friday. Consideration by the 25th. Happy days. Well, I'll be looking forward to that. So that's something to look forward to for me. Anyway, a couple of things I was going to quickly sort of talk about. I mean, where are we up to on time? Oh gosh, we're at an hour. I was just going to quickly say, I mean, CAML, I cannot believe that's at £1.40. They are the lead contender to get an American mine. If they get outbid, if they get out whatevered by Quintera, well, they'll get to sell 12% of the company to Quintera at an elevated price, at a profit. I sort of said if it ends up at 33% above the buy price, well, that'll be worth 10 million Australian, which is, it's 2.8p per share. So again, it's like guaranteed upside at this point. If it goes ahead, great, because the economics of Antler are great. I think, in fact, let's just check. Yeah, so this one here, Antler, and then Snowflake is the Kintera people. So Snowflake's Antler and CAML. The pictures always tell 1,000 words. Yeah, like it's a win-win either way, as far as I can see, because even if they don't buy Antler, well, I mean, the copper in Coonrad is doing well. Like that's when I looked at sort of the other thing was that they released some results where people said, "Oh, hang on, oh, they've reduced guidance, and the zinc and the lead have not performed." Well, it kind of doesn't really matter, because copper price is up, zinc price is down, the lead price is down. When you look at it overall, like the copper outweighs so the loss of performance at Sasa is outweighed by the increase of performance at Coonrad. Overall, that actually the profit should be about 2 million higher, 2 million US. Then you've got the whole thing with Aberdeen. That actually looks quite exciting. I was just looking at some pictures on Twitter about the drilling that they're doing, and they apparently presented at a Cornwall conference. So we'll wait and see, but I think there's some opportunity there. And I just sort of just said, well, look, if it falls through with Antler, it's not the end of the world. There's other places. I mean, how many bombed out miners are there on the UK market? I mean, like, not being funny, but I mean, there's no shortage of options and optionality that CAML could buy, and and in any case, I mean, their existing mines have got a long life left in them anyway. So I just don't get this £1.40 price. It's completely completely out of sync to the opportunity. I mean, 246 million market cap, when like these guys. So let's have a look. Let's have a look. It's this. They're chucking off of and this was sort of on the results to 31st of December. So what, 50 million US is what, 40 million UK. So that's price earnings of 6 times. And they're chucking off an 18p dividend that they can afford to chuck off, which on a £1.40 share, I mean, that's 12.6%. So again, kind of quite liked that. There's a couple of other ones I was going to quickly mention, but I mean, we're probably out of time really. An hour is probably more than enough. I think Venture Life's another one that dropped and has sort of risen back up today. It closed at 60p, but I just couldn't believe that had dropped down. I think it dropped to about 56p. And I think on the results it was at 63. So the pullback was an opportunity as far as I was concerned. I'm also very excited about ECR. I think when I wrote this article, Antimony, Antipathy, and Antipodes, I kind of looked at it and I was like, I'm not clear that they've got the cash to do all these things. They've since said that they do, that like this thing about the strong cash balance, that that they say that they've got the cash to do. So it's this bit by here, the near term. That they're going to be maybe leasing a wash plant, or they're going to be, there's different things, but they say that it is fundable and funded, that they're not going to have to go back out to market. And I'm going to just sort of take that at face value. It's also the case that whilst the overall average is 0.38, that there's some good ground and bad ground. So, I think what they're sort of working towards is, well, let's get good ground. Let's work out where the good ground is. Let's start mining that, and, maybe sort of doing it. So this thing about sort of 0.7 million low capex and no capex, I mean, yes, if they were buying it, but no, what if they lease it? So there's, again, I think that we could see some good news on ECR. I'm very excited about, again, on Monday, LendInvest are going to be announcing their results. I do think that we could see poor Uncle Derek Uncle Derek is just an imaginary figment of my imagination. There is no Uncle Derek or any sort of connection to that with LendInvest. It's just a bit of fun, but yeah, when I sort of ran the numbers, I think the thing that struck me was that when you look at the rate at which, I mean, A, that they've got some very good write-ups from their own customers, B, that the amount of lending is going in the right direction, upwards, that the cost of lending is going down, so the margin is improving, that income is heading in the right direction. And I sort of worked through the numbers and sort of said, that like you can sort of see it here on the base under management are now at or around 5.4 billion. And on the basis that they've sort of deployed, say, 3.3 billion of those funds, I mean, basically it works through, if my facts are correct, that we'll see quite a strong result. I mean, a 4 million result on a share that you can buy for, I think it's 40 million. Just quickly grab the, yeah. So it's again, it's sort of very. I think potentially this could go shooting up on Monday, but I could be completely wrong. I could, but the thing that struck me was that they, yeah, so a 53 million market cap, so 4 million. I mean, it's not going to be an overnight sensation, but you can sort of see, we could see profit before tax of rising upwards, and at 50 million. That sort of puts it on five times earnings. So yeah, I kind of feel quite positive about this one, really. And at the end of the day, the value of this is not just its ability to generate profits, it's the software that they've developed. That when I looked at the software, they'd written that down. That they'd spent, I think they'd invested 60 million. They'd written it down over the years by, they've written off 50 million. So when I say write off, they've amortized it. So it's on the books for 10 million. But the software is still as useful as it was all those years ago. So yeah, I think there's some hidden value. And when you consider the likes of, say, Cushion, for example, that got sold for 169 million, well, Cushion compared to what these guys have built. And I kind of go back to this thing of, well, when they can do a complex application in 5 minutes, and pretty much every other bank takes 10 minutes, 20 minutes, 30 minutes, 15 minutes. David Wilson Homes say you need 3 to 6 hours to complete a mortgage application. I mean, certainly my experience was probably more towards the 6-hour mark, and I'm not a particularly complicated chap. Maybe I'm just slow, but judging by the number of articles I write, I'm not slow. But anyway, the fact that they reckon 5 minutes, I mean, that has got to be worth something to somebody in the financial sector. So could this just get bought out at some point? I'll leave you to ponder that one. Anyway, I think that's probably enough from me. I kind of covered most of what I was going to cover. I think I was going to mention Molten and Revolut, but I've written an article on that, so it's just a case of reading the article pretty much. But I just think that when this revaluation of Revolut, potential revaluation to from 45 billion to 65 billion, which hasn't happened yet, but they're in talks of doing another funding round, that would add 38.7p to grow. And kind of when you look at everything else that's going on with grow, I mean, it's all heading in the right direction. You can sort of see here the fair value movement, 72 million on a share where the market cap is 630, I think it was earlier this week. So I mean, it's growing by about 11-12% a year, net of its losses. You can see like these, and even these ones like Thought Machine that's down 29 million, this one that's down 8 million. If you go and read my first half article, those losses were in the first half, not in the second half. In fact, the losses reversed in the second half. So I mean, you know, again, like Thought Machine, I think has got a very bright future ahead of it. So the fact that it's valued just at 39p when it's banking software that's being rolled out to several different banks. I think it was oh, who was it? Chase. I think it was Chase Manhattan that have rolled it out this year. I think I'm right in saying. Might be wrong on that, but I think that's. I think I've got that right. So you can sort of see it here with, yeah, you know, that they're sort of rolling it out to Affin. They're rolling it out to, you know, they're the leader in the Magic Quadrant for Gartner, and yeah, I think it's in a different article where I talk about it. But yeah, when you sort of, you know, get to sort of say, was it here, ICI, which is sort of a satellite holding, and Form 3 and Thought Machine, like at this point here, this is the share price, and then sort of you've still got like other top holdings that are all good stuff, you know, they're all solid, they're all going up in value, and then you've got another £3.55 of other stuff in AI and so on. And you just look at all these AI revaluations that are going on, and you know, I think with these, because they are British or because they're European, like people don't care whether AI is European or American or Japanese or whatever else. If the software, if the platform, if the, you know, if it's valuable, then it'll fetch a good price. And we've seen that, you know, we've seen INOV, for example, you know, like, oh yeah, you know, our secret AI holdings have doubled in value this year, and things like this. So yeah, I mean, Grow's got plenty of it, you know, plenty of AI themed stuff, but also just stuff to do with crypto, and you know, picks and shovels stuff on crypto, and digital health's another one. So yeah, I you know, and like for it to be at a 51% discount, it's just crackers as far as I'm concerned. So anyway, that's enough from me. Apologies that the video, the recording's an hour and 15. It's longer than I thought I'd do, but lots to talk about, lots of reasons to feel positive. And yeah, you know, you can catch my articles at theoakbloke.substack.com. You can catch me on Twitter if you so choose, or you can catch me on YouTube. I mean, I of course would appreciate you sharing and liking and thumbs upping and all the rest of that good stuff down there if you would. Really appreciate that, and thank you for watching this, and I hope that's been useful. As I say, none of this is advice. You make your own investment decisions, but hopefully it gives you some food for thought for you to go and investigate these ideas a bit further, and for you to make a decision. Anyway, enough from me, Oak Bloke, signing off. Cheerio for now. Cheerio.